What if I told you that the money you worked your entire life for, the state pension you earned through decades of hard work and national insurance contributions, could now be taxed in a way that leaves you significantly worse off every single month? That is not a scare tactic. That is the reality that millions of state pensioners across the United Kingdom are now facing, and financial experts are calling the implications of these tax changes not just serious, but significant. If you are a state pensioner, if you are approaching retirement, or if someone you love depends on the state pension, you need to watch this video all the way through, because what we are covering today could directly affect how much money you actually take home every single month for the rest of your life. Welcome to UK State Pension with David, the channel dedicated to helping pensioners and those approaching retirement understand their rights, their money, and the changes that affect them most. I am David, and every week on this channel we break down the complex world of pensions, benefits, and government policy into clear, honest, and straightforward information that you can actually use in your daily life. If you are new here, please subscribe and hit the notification bell so you never miss an important update. And if you find this video helpful, share it with a friend or family member who is on the state pension, because this information genuinely matters and more people across the United Kingdom need to hear it right now. So let us get straight into it. The warning has come from financial analysts, pension specialists, and consumer organisations across the UK, and it centres on the intersection of two very important things: the ongoing triple lock increases to the state pension and the freeze on income tax thresholds that the government has been maintaining for several years now. Individually, each of these things sounds straightforward enough, but together they are creating a situation that pension experts are now describing as a fiscal drag that is quietly and steadily pulling more and more pensioners into the income tax net for the very first time in their lives. And the vast majority of those pensioners have absolutely no idea it is happening to them. Here is how it works. The triple lock guarantee means that the state pension rises each year by whichever is highest out of inflation, average earnings growth, or 2.5%. This is a policy that was designed to protect pensioners from the rising cost of living, and it has done exactly that over the years. The full new state pension has been rising steadily, and in April 2026 it is set to increase again by 4.1%, bringing it to approximately £11,973 per year. That is meaningful money and a genuinely important protection for millions of people who rely on it as their primary source of income. However, the personal allowance, which is the amount of income you can receive before you start paying income tax, has been frozen and is set to remain frozen for a number of years, according to current government plans. Do you see the problem forming here? The state pension is going up every single year. The tax-free threshold is staying exactly where it is, and the gap between the two is shrinking every single year without fail. At the current rate of triple lock increases, the full new state pension could come dangerously close to, or even exceed, the personal allowance within just a few years. When that happens, pensioners would effectively owe income tax on part of their state pension income, something that would have seemed almost unthinkable to many people who spent their whole working lives believing their pension would be safely and comfortably below the tax threshold forever. This is precisely what financial experts mean when they talk about significant implications. It is not a dramatic overnight change that hits you all at once. It is a slow, steady squeeze that catches people completely off guard because they are not expecting it and because nobody in authority has sat down and clearly explained it to them in plain language. And that is exactly why we are talking about it today on UK State Pension with David, because you deserve to know the truth about your own money. Now let us be very precise about who this affects and how. If your only source of income is the full new state pension, you are currently still just below the personal allowance. So right now, in isolation, you are not paying income tax on your state pension alone. But if you have any additional income on top of that, and this is where so many pensioners across the country get caught out without realizing it, the situation changes immediately and significantly. Additional income can come from many different places. It could be a workplace pension or a private pension that you built up over the course of your working years. It could be rental income if you own a property that you let out. It could be interest on savings that you have built up. It could be income from a small part-time job. It could come from an annuity. Any income you receive on top of your state pension directly reduces how much of your personal allowance is available to shelter the state pension itself from tax. So if you receive even a modest amount from an old workplace pension, and you also receive the full new state pension, your combined total income may well exceed the personal allowance. The portion of your income that sits above that threshold is taxable at the basic rate of 20%. For someone on a fixed and limited income, that tax bill is a meaningful and painful sum of money. And many pensioners have never had to think about income tax at all before reaching this stage of their lives. So the administration and paperwork alone can feel completely overwhelming and confusing. The way HMRC typically collects this tax from pensioners is through a tax code adjustment applied to their private or workplace pension payments. But here is something critically important that you need to understand. HMRC does not always get this right automatically, and it does not always communicate clearly or promptly when your tax situation changes. There are pensioners across the United Kingdom right now who either do not know they have a tax liability building up or who are paying the wrong amount of tax entirely because their tax code has not been properly updated. Both of these situations can cause serious financial problems further down the line. Underpaying tax means you will eventually receive a demand for money you were not expecting and may not have set aside. Overpaying means money is being quietly taken from you every month that you are fully entitled to keep in your own pocket. So what should you actually do about all of this? The first and most important thing is to know your numbers. Do you know exactly how much income you receive from all sources across the entire year? Your state pension, any workplace or private pensions, savings interest, rental income, absolutely everything that comes in. Add it all up carefully and compare it to the personal allowance. If your total annual income exceeds that figure, you are in the tax system whether you currently realize it or not. If it does not exceed that figure right now, keep watching the triple lock increases very closely in the coming years, because you could cross that threshold sooner than you might expect. The second thing is to check your tax code. If you receive a private or workplace pension, the organization paying that pension will be using a tax code provided by HMRC to determine how much tax to deduct from your payments each month. Your tax code should accurately reflect your full income picture from all sources. If it does not, you could easily be paying the wrong amount of tax without knowing it. You can check your tax code by looking at your pension payslip or by accessing your personal tax account through the government's official online services. It is genuinely worth doing this check at least once a year, and particularly around the time of annual pension increases in April, when your income goes up and your tax situation may shift as a result. The third practical step is to think carefully about whether you and your household are making full use of all available allowances. For couples where one partner has income below the personal allowance, there is a scheme that allows the lower earning partner to transfer a portion of their unused personal allowance to the higher earning partner, which can reduce the household tax bill by a meaningful amount each year. It is a relatively straightforward arrangement to set up, and for many pensioner couples, it represents a useful and legitimate saving that they are simply not taking advantage of. There is also a much broader conversation taking place right now about the future of the triple lock policy itself and the continued freeze on income tax thresholds. Many campaigners, pensioner advocacy groups, and independent financial bodies are now arguing loudly that the government cannot continue to apply the triple lock while simultaneously keeping the personal allowance frozen, because the inevitable mathematical result is that the state pension eventually becomes a taxable income for people who have absolutely no other financial cushion or safety net beneath them. Age UK and several other respected organisations have raised serious concerns about this trajectory and called for the personal allowance to be uprated alongside pension increases in order to genuinely protect the lowest income pensioners from being quietly dragged into the tax net against their will and without their understanding. The government's position so far has been to maintain both policies side by side, arguing that the triple lock protects pensioners from the cost of living, while the threshold freeze is necessary to help repair the public finances after years of significant spending. But the tension between these two aims is very real, and it is ordinary pensioners who find themselves caught uncomfortably in the middle of that tension every single year. At UK State Pension with David, we will continue to monitor closely how this situation develops and bring you updates as soon as anything changes at the policy level or in the law, So please make sure you are subscribed and have your notifications turned on so you never miss a critical update that could affect your income. One more thing that is absolutely worth mentioning is the importance of pension credit. If you are on a lower income and you are not currently claiming pension credit, this is something you should look into as a matter of priority. Pension credit is a means-tested benefit that tops up your weekly income if it falls below a government-set minimum threshold. Crucially, receiving pension credit also unlocks access to a whole range of additional help and support, including assistance with housing costs and support with certain other costs of living. Every single year in the United Kingdom, enormous amounts of pension credit go completely unclaimed, and the people who miss out are almost always those who need that financial support the most. Many pensioners simply do not know they are eligible, or they assume incorrectly that claiming benefits is too complicated or too intrusive. It is neither of those things, and if there is any chance you might qualify, it is always worth finding out. The core message of today's video is straightforward but deeply important. The tax landscape for state pensioners in the United Kingdom is changing, not dramatically or suddenly all at once, but steadily and consistently year after year, with very real financial consequences for very real people living on fixed incomes. The triple lock is working exactly as it was designed to work, raising your pension year by year to keep pace with the cost of living. But the frozen personal allowance means that more and more of that pension income is now potentially visible to the tax authorities. You need to know exactly where you stand financially. You need to understand your full income picture, and you need to make sure you are neither overpaying nor unknowingly underpaying tax on your hard-earned pension. And if any part of this feels complicated or confusing, do not try to navigate it entirely on your own. Speaking with Citizens Advice or consulting with a regulated and qualified financial advisor can make an enormous and lasting difference to your financial well-being in retirement. Thank you so much for watching all the way to the end of today's video. If this helped you understand something genuinely important about your pension and your tax situation, please give this video a like because it really does help more people find this channel and access the clear information they deserve. Share it with a pensioner friend, a neighbor, or a family member who might be directly affected by these changes and who needs to know about them. And if you have not already done so, please subscribe to UK State Pension with David so that you stay properly informed every single step of the way through whatever changes come next. I am David, this is UK State Pension with David, and I will see you in the very next video. Take care of yourselves, stay informed, and always remember that your state pension is your right. You earned it. Make sure you protect every single penny of it.